If you've ever wondered why America's debt keeps rising, year after year, no matter who's in the White House, you're about to see a side of the system that rarely reaches the public eye. For more than 300 years, the United States hasn't just borrowed money, it has built an architecture of debt, a structure designed not to end, but to continue. And the most unsettling part is this: it has worked exactly as its architects intended. Today, we're going to follow the money from London in 1694 to New York in 1913, and through the Volcker shock of 1982, to answer a question millions of Americans, especially those nearing retirement, still ask. If our economy is so productive, why does the national debt never go down? The answer has little to do with taxes, spending, or politics. It lies in the architecture, in how money is created, circulated, and profited from, often by forces most citizens never see. Once you understand who benefits, who pays, and who designed this machinery, you'll never look at America's national debt the same way again. And by the end of this video, you'll understand why U.S. debt isn't a glitch in the system, but the system's most essential feature. For most of American history, we've been told a simple idea: a nation in debt is a nation in danger. But here's the paradox almost no one talks about. The United States is not primarily indebted to foreign powers. America is, in large part, in debt to itself. Roughly 2/3 of U.S. government debt is held by Americans. Through Social Security, Medicare trust funds, pension plans, treasury bonds, and index funds that millions of retirees depend on. It's a strange arrangement. The nation owes trillions of dollars to the very citizens counting on that money to survive retirement. Let's make this real. Anyone who has followed the markets for years has seen Treasury yields climb, crash, and climb again in an almost familiar rhythm. When interest rates rise, the value of existing bonds, including the ones in your 401k or pension, goes down. At the same time, the government must pay more interest on new debt, pulling money away from programs like Medicare and Social Security. So the very people who spent a lifetime paying into the system often feel the pain twice, once as taxpayers and again as retirees watching markets whipsaw their savings. That's the heart of the paradox. How can a nation be both the borrower and the lender, the payer and the paid? And more importantly, why would any country design a system like this in the first place? Here's a small lesson from economic history. Debt becomes dangerous not when it is owed to adversaries, but when it becomes so woven into daily life that the entire society depends on its growth just to function. America didn't stumble into this paradox by accident. It evolved, step by step, through decisions made long before any of us were born. Decisions that shaped how money is created, how benefits are funded, and how risk is quietly passed to future generations. And later in this documentary, we'll return to this paradox. And when we do, it may change the way you think about every dollar you've ever earned. But before we get there, we need to go back, far back, to the moment when the idea of perpetual national debt was born. To understand how America's debt system was built, we have to travel back, long before Wall Street, before the Federal Reserve, even before the United States itself existed. The story begins in 1694, in a Europe torn apart by war. At the time, England and France were locked in a costly conflict that drained the British treasury to the bone. Taxation alone couldn't keep up. The English crown was already collecting duties on everything from salt to windows to fireplace hearths, yet it still wasn't enough. The working class, mostly men laboring in ports, mines, and shipyards, felt the burden most. Their wages barely kept pace with rising levies, and every new tax meant less bread on the table. Debt in this era was supposed to be temporary, a tool to survive wars, then paid off as soon as peace returned. But war kept returning, and this is where one man changed everything. William Paterson, a Scottish trader with a reputation for unconventional thinking, proposed something radical. Instead of borrowing money and paying it back, what if England created a perpetual debt, a loan with no expectation of ever being fully repaid, only serviced through interest? In modern terms, he reinvented national financing. Before Paterson, governments borrowed the way families did: take a loan, repay the principal, close the account. Paterson suggested the opposite: keep the principal forever and simply pay interest indefinitely. To the English crown, drowning in war expenses, this was a lifeline. To investors, wealthy merchants and London bankers, it was even better: a guaranteed government-backed stream of income, year after year, generation after generation. But to the ordinary Englishman, struggling under taxes that grew heavier with each conflict, it was a silent shift, one that changed his relationship with the state. Instead of paying for a finite war, he was now paying for a permanent financial engine. Here's the quiet truth: perpetual debt allowed governments to fight wars without asking the public for permission each time. It created a new kind of stability for elites and a new kind of dependency for citizens. And a small lesson emerges here: debt becomes dangerous the moment its end date disappears. Temporary debt demands accountability. Perpetual debt removes it. Paterson, of course, could not have known that his model would ripple outward, shaping Europe's financial systems, inspiring future central banks, and eventually laying the foundation for the American approach to money creation. And what he certainly didn't know was this: the mechanism he introduced in 1694 would one day collide with a powerful force in the United States, a force that would transform perpetual debt into something even larger. Before we reach that turning point, we need to understand how this idea, born in London, spread across continents and became the backbone of global finance. That story begins with a name the world still remembers. By the early 1800s, Europe was exhausted. 2 decades of Napoleonic wars had drained national treasuries from London to Vienna. Governments were desperate for money, not in small bursts, but in reliable, continuous streams that could fund armies, rebuild cities, and stabilize currencies shaken by conflict. Into this chaos stepped a family whose name still echoes through financial history: the Rothschilds. What made the Rothschilds different wasn't just wealth. It was speed, information, and a brilliant understanding of debt. While most bankers operated within one city, the Rothschilds had built a network: 5 brothers, stationed in London, Paris, Frankfurt, Vienna, and Naples, each sharing intelligence faster than any government could. And this gave birth to something revolutionary: the secondary market for government bonds. To understand why this was groundbreaking, imagine how debt worked before 1815. Governments issued bonds, and investors held them. Simple. But the Rothschilds introduced a way for investors to trade those bonds among themselves, turning national debt from a static IOU into a dynamic market. Here's a modern analogy. Instead of taking out a home loan and keeping it for 30 years, imagine your bank could sell your mortgage to someone else, who could sell it again and again and again. The loan becomes part of a larger machine, fluid, mobile, and interconnected. That is what the Rothschilds did for nations. This innovation carried huge advantages. Countries could borrow more easily, fund projects more quickly, and attract investors from across Europe. But it also came with a hidden cost, one that anyone who has lived through financial shocks or market downturns will recognize instantly. Risk didn't stay where it started. It spread. Once a government bond entered the secondary market, its fate was no longer tied only to the country that issued it. A banking crisis in Vienna could shake confidence in London. A failed harvest in France could rattle bond prices in Frankfurt. What had once been isolated national debts became threads of a single, continent-wide web. To make this clearer, consider an American example. During the Civil War, the U.S. government issued greenbacks and war bonds to fund the Union Army. But unlike Europe, where the Rothschild network quickly globalized debt, most American bonds stayed domestic. That meant when the war ended and markets stabilized, the financial shock was largely contained within U.S. borders. Europe had no such insulation. A crisis in one capital could sweep across the entire bond network in days. And by 1815, as the Rothschilds helped Britain finance its final push against Napoleon, one truth became clear. No government could fully control a debt system once it entered global circulation. Yet many still believed they could, insisting they could manage the flows, regulate the markets, and keep risk within political boundaries. This was their greatest mistake. They didn't understand that once debt becomes global, it stops obeying borders. For anyone who has lived through decades of economic cycles, this dynamic may feel familiar. The pension funds you rely on, the treasury bonds inside your retirement accounts, even the interest rates on your savings, these are all shaped not only by Washington, but by markets in Tokyo, Frankfurt, and London. Debt, once set free, connects nations in ways that policymakers rarely admit publicly. And here's where our story takes a sharper turn. Because as powerful as the Rothschild network was, everything they built was still rooted in a world of ships, couriers, handwritten ledgers, and slow communication. The true transformation, the moment debt became not only global, but limitless, would come from across the Atlantic. A force would emerge in the United States that made perpetual, interconnected debt seem modest by comparison. And that force would change the world again in the early 20th century, starting on a quiet island off the coast of Georgia. By the early 1900s, America had become an industrial powerhouse. Railroads, steel, manufacturing, and millions of new consumers. But beneath that growth, the U.S. financial system was fragile. Banks were scattered, reserves were inconsistent, and money didn't always flow where it was needed. One crisis could freeze the entire economy. That moment came in 1907, when a failed attempt to corner the copper market triggered a wave of panic. Banks collapsed. Trust companies shut their doors. Lines of anxious depositors stretched down city blocks. And in the absence of a central authority, one man, J.P. Morgan, stepped in. He gathered bankers in his private library, locked the doors, and demanded they pool resources to save the system. It worked, but it terrified the country. The idea that a single financier could rescue or endanger the U.S. economy made clear that America needed something more stable than private heroism. This set the stage for 1913, when Congress created the Federal Reserve, a central bank designed to stabilize money, manage crises, and serve as the lender of last resort. But it also introduced something far more powerful, a mechanism that allowed debt to expand indefinitely. Here's how it worked in simple terms. Before the Fed, money was tied directly to physical gold or the reserves individual banks held. After the Fed, money could be created when the government issued new bonds, and the Fed purchased those bonds. In other words, new debt, new money. Debt was no longer a temporary tool. It became part of the money supply itself. A useful analogy is this. Imagine refilling a water tank by attaching the hose to the tank's own drain. The more water leaving the tank, the more water you pump back in. The cycle sustains itself, as long as people trust the plumbing. And this trust created a new kind of dependency. Before 1913, America's financial stability was unpredictable, but independent. After 1913, stability improved, but it came at the cost of tying the entire economy to the continual issuing of government debt. The system functioned best not when debt shrank, but when it grew. The lesson here is subtle but profound. When money is created from debt, the system quietly requires more debt over time, not less. That's why modern discussions about paying off the national debt rarely align with how the financial architecture actually operates. And toward the end of this documentary, we'll return to this idea, because once you understand how this machine works, you'll see why $38 trillion cannot simply be paid down, and why the very existence of the Federal Reserve ensures that. But before the Fed could reshape America, another global turning point would push the world even deeper into dependence on growing debt. And it began in the turbulent years of the 1980s. By the late 1970s, the post-war boom had curdled into something darker. Inflation in the United States was running in the double digits. Prices were rising faster than wages. People watched the value of their savings melt away, month after month. Gas lines, mortgage rates in the teens, grocery bills that seemed to jump every week. Trust in the dollar was evaporating. When Paul Volcker became chair of the Federal Reserve in 1979, he made a decision that would redefine the global debt system. He chose to crush inflation at almost any cost. Between 1979 and 1981, the Fed pushed short-term interest rates from around 11% to nearly 20%. On paper, that's just a number. In real life, it was a shockwave. If you imagine having a variable rate mortgage and waking up to find your monthly payment nearly doubled, you have a sense of what those years felt like for borrowers. Inside the US, the pain was immediate. Businesses failed, unemployment rose, and the early 1980s became one of the toughest recessions since the Great Depression. But outside the US, something even more consequential was happening. For years, countries like Mexico, Brazil, and Argentina had been encouraged to borrow in US dollars. When rates were low and dollars were plentiful, it seemed manageable. Their governments rolled over old loans, took on new ones, and bet on future growth to carry the burden. Volcker's rate shock hit the world in three powerful waves. First, higher US interest rates pulled capital back to American shores. Global investors rushed toward the safety and unusually high returns of US Treasury bonds. Second, the cost of existing dollar-denominated debt soared overnight. Countries earning their income in weaker local currencies suddenly faced loan payments that felt impossible to manage. And third, governments had no choice but to borrow even more, not for new projects or expansion, but simply to keep their financial systems from collapsing. In 1982, Mexico finally said what many others were thinking: it could no longer meet its obligations. That moment marked the beginning of the Latin American debt crisis. Brazil and Argentina soon followed, and an entire region was pushed into years of austerity, IMF negotiations, and repeated restructurings. Here's the key point: these countries weren't just in debt, they were caught in a permanent refinancing loop, borrowing to pay interest on previous borrowing, under terms largely shaped by institutions outside their borders. A small but powerful lesson emerges from this era. When a single country controls the world's key interest rate, it doesn't just fight its own inflation, it gains leverage over everyone who borrowed in its currency. Volcker is rightly credited with bringing US inflation under control. But there's a second legacy that's talked about far less. He helped turn sovereign debt into a global instrument of power. After the 1980s, it became clear that no modern nation could easily exit the debt system. The only real choice was how to manage, roll, and negotiate obligations inside it. And that brings us to the present. Because today the architecture built over these centuries, from Paterson's Perpetual bonds to the Rothschild network to Volcker's rate shock, has hardened into something even more intricate, a machine in which new debt, new money, and global finance are woven together. In the next part, we'll step inside that machine and ask three simple questions. Who buys the debt? Who pays the interest? And who quietly profits from the way it's all structured today? Today, the debt system is no longer a collection of ledgers, couriers, and handwritten bonds. It is a vast digital engine, one that moves trillions of dollars with a keystroke, And understanding who buys America's debt, who earns the interest, and who ultimately pays the bill is the key to understanding the architecture we live inside every day. Let's start with the most recent numbers. As of 2025, the U.S. national debt sits above $38 trillion, and interest payments alone are projected to cross $1 trillion a year, more than the nation spends on veterans' health care or education. But that money doesn't disappear, it flows somewhere, and it flows into the hands of four major bondholders. First, the Federal Reserve, the system's stabilizer. The Fed isn't a traditional investor. It doesn't buy treasury bonds for profit. It buys them to manage liquidity and stabilize markets. During periods of stress, like 2008 or 2020, the Fed steps in, purchases massive amounts of government debt, and injects money into the financial system to prevent collapse. Think of the Fed as the emergency brake. When the machine overheats, the Fed absorbs debt to cool it down. But purchasing those bonds still means the Fed collects interest, which ultimately flows back into the Treasury. A loop inside a loop. Second, pension funds, which end up fueling the system almost unintentionally. Here's the part most people don't realize. A large portion of U.S. government debt is held by retirement funds. If you've ever contributed to a 401k, a teacher's pension, a firefighter's fund, or a public employee retirement plan, part of your money almost certainly ended up in treasuries. Why? Because treasuries are considered the safest asset on earth. But that safety comes with a twist. Retirees indirectly fund government debt through the savings they rely on. They are both investors in the system and subjects of it. When interest rates rise, pension funds may earn more on new bonds, but the value of the old ones drops. When rates fall, the opposite happens. In either case, retirees are deeply tied into the rhythm of America's debt engine, whether they choose to be or not. Third, insurance companies, the long-term planners. Life insurance, annuities, disability coverage. These industries must invest long-term, conservatively, and predictably. And so they buy enormous amounts of treasury bonds to ensure they can meet future payouts. Your monthly insurance premium doesn't just sit in an account. It enters the bond market, becomes part of the funding mechanism for government spending, and generates interest that helps insurers stay solvent decades into the future. It's a hidden connection. People protect their families by becoming lenders to the U.S. government. And finally, foreign governments using U.S. bonds as the world's financial safety net. Foreign holders own roughly 25 to 30% of U.S. debt. Japan is the largest. China is second. Other nations, from the UK to Switzerland to Middle Eastern investment funds, hold treasuries as reserves, much like families keep emergency savings. Why? Because the dollar remains the anchor of global trade. Holding U.S. bonds is less about profit and more about stability, leverage, and trust in America's financial system. But this also creates a delicate interdependence. The U.S. needs buyers. Those buyers need stability. Stability requires debt to keep circulating smoothly. So who truly benefits? Bondholders earn interest. The government receives the funds it needs to operate. The financial system gains predictability. But taxpayers, through income, savings, and retirement accounts, supply much of the capital that keeps the system running. And a quiet lesson emerges. The modern debt machine isn't something outside of us. It's something we are all woven into. Whether through pensions, insurance, savings, or global reserves, the world participates in America's debt. And America's debt, in turn, stabilizes the world. But there's a question almost no one asks. A question this video must answer before it ends. What would happen if the United States actually tried to pay off its debt? And that's where we're headed next. When people talk about America's national debt, the conversation usually sounds simple. Why don't we just pay it off? The truth is far more counterintuitive and far more revealing. In the modern financial system, government debt and the money supply are two sides of the same coin. For every dollar the government borrows, a dollar enters the economy. Treasury bonds become assets held by pensions, banks, insurers, and investors. If the United States suddenly paid off all its debt, those assets would vanish, and with them, a huge share of the money circulating through everyday life. A simple analogy makes this clear. Imagine a family paying off its mortgage in a single day. Great for the homeowner, but devastating for the bank. The moment the debt disappears, so does the bank's income stream. Multiply that across millions of loans, and the system shrinks. Fewer loans, fewer deposits, less credit, less economic activity. The entire structure contracts. That's exactly what would happen if the U.S. eliminated its national debt. Paying off the principal would destroy money, literally remove it from the financial system. And when money disappears faster than the economy adjusts, the result is a deflationary spiral. Falling prices, collapsing credit, shrinking wages, business failures, and a rapid freeze in economic momentum. This is why two common solutions, just cut spending or just raise taxes, don't work the way people imagine. Cut spending too aggressively, and the government withdraws money from the economy, slowing growth and reducing tax revenues. Raise taxes too sharply, and households, businesses, and state governments lose the cash flow needed to keep the system moving. In both cases, revenue falls faster than debt can be paid, and the cycle tightens instead of loosening. So the issue isn't mismanagement or political incompetence, it's structure. America's financial architecture runs on debt the way a circulatory system runs on blood. Reduce it too quickly, and the system doesn't get healthier, it goes into shock. And here's the lesson hidden in plain sight. The question has never been whether the United States should repay its debt. The real question is what happens when the entire global economy is built on the assumption that it never will. Which leads to the most uncomfortable part of this story, a part almost no one discusses publicly. Who actually designed this system, and why would the people who built it have no interest in stopping it? That answer begins with the architects who connected the pieces, and the final turning point that made perpetual debt inevitable. When we talk about America's debt, it's easy to imagine a simple relationship. The government borrows, taxpayers pay, end of story. But in today's financial world, the real beneficiaries are not just governments. They are the asset managers, the giants who oversee trillions of dollars on behalf of retirees, institutions, insurance pools, and global investors. Three names dominate this landscape: BlackRock, Vanguard, and State Street. Together, they manage over $20 trillion. And in the background of every portfolio they build, from index funds to retirement plans, sits an enormous pile of U.S. Treasury bonds. Why? Because Treasuries offer what no other asset can: a blend of safety, scale, and liquidity big enough to anchor the entire investment ecosystem. Here's where the system becomes revealing. Every year, the U.S. government now pays over $1 trillion in interest. That money flows into the bondholders we discussed earlier, including these asset managers. They collect the interest, pass a share of it to clients, and reinvest the rest into more bonds, more funds, more assets. It's not corruption, it's architecture. To people saving for the future, this can feel invisible. But think of it like this: when interest payments rise, they act as a hidden tax, pulling money from the federal budget and redirecting it toward bondholders. Instead of funding infrastructure, healthcare, or education, a growing portion of national income becomes a transfer to those who own government debt. For retirees and long-term savers, the effect is double-edged. Their 401ks and pension plans depend on treasuries to stay stable. Yet those same treasuries require a constant stream of interest funded by taxpayers and future generations. A small lesson sits quietly inside this loop. The debt machine rewards stability, not repayment. The longer debt remains, the more valuable it becomes for the institutions built around it. And so the question is no longer simply, who holds America's debt? It becomes, who benefits from keeping it alive? As we move forward, the picture will become clearer. Because the system's modern custodians, from asset managers to central banks, are only part of the story. To see the full architecture, we have to step back and trace the line that connects all the architects we've met so far, straight into the heart of the world we live in today. When we step back and look at the last 3 centuries, a pattern emerges. A pattern so consistent it's difficult to call it accidental. William Paterson gave the world the first blueprint. Debt didn't need an end date. It could be permanent, a constant source of funding and influence. The Rothschilds expanded that idea across borders. Debt became global, traded between nations, no longer confined to any single government. J.P. Morgan pushed the concept into the industrial age. Through the creation of the Federal Reserve, debt became infinite, capable of expanding whenever the system needed stability. And Paul Volcker revealed the final layer. By raising interest rates to historic heights, he showed that debt had become inescapable, a force that bound nations together through global finance, interest payments, and shared vulnerability. Each figure lived in a different era, each faced different crises, yet together they shaped a single architecture, a world where debt is the backbone of money, markets, and modern economies. And the lesson is simple. This system wasn't built overnight. It was engineered, layer by layer, across 300 years. But there's one final piece we haven't uncovered yet. The part that reveals why America's debt isn't a problem to be solved, but a feature the entire global economy now depends on. That understanding comes next, in the final chapter of this story. When we return to the paradox that opened this story, the picture is finally clear. America's debt isn't a flaw in the system. It is the system. It's the foundation beneath the dollar, the anchor of global finance, and the mechanism that keeps money circulating through households, markets, and governments. National debt isn't like a family mortgage. Families pay theirs off, but nations create money through theirs. Trying to eliminate it would collapse the very structure it supports. The real lesson is simple. The goal was never to pay the debt down. It was to manage it, stabilize it, and use it to power an economy built on trust and liquidity. And once you see that, every headline, every budget fight, every market swing begins to make more sense. In the end, there's only one rule worth remembering. Follow the money. It always reveals the architecture underneath. And in our next chapter, we go one level deeper. Who actually controls the dollar? And why is steady inflation something they quietly depend on?